Okay, welcome back. Now let's grow what we've been talking about so far. So let's start again with our accounting equation. Assets, let me change my pen color. Assets are equal to capital plus liabilities. So the purpose of any business is to make profit. The key purpose is to make profit. The fundamental purpose is to make profit. So we'll just jump into, an equation situation where we have this is equal to this plus this. Right, that's where we are. So this is money in the bank. Let's just assume that they don't need any machines. Let's just assume that this business is just, they're going to work and they're going to pay rent, if you like, for any rooms or anything they need. In accounting, we recognize transactions individually. So we always recognize transactions that are actually happening. We don't cross out things. So if the aim of this business is, for example, to sell else addresses, let's assume all these else addresses, all this money is used to buy else addresses. So for example, we use all the money in the bank here, and we go along and we buy some else addresses. Our intention is to sell those else addresses. When we buy a machine, we don't intend on selling the machine. When we buy a building, we don't intend on selling the building. And anything we intend on selling to make money is referred to as an expense, or anything that will help us generate that money is referred to as an expense. And this is, it's an equation. We could recognize these letters on any side of the equation, but just for the convention is that we recognize expenses on this side of the equation. So we recognize the fact that we have bought £60,000 worth of goods that we intend to sell. So we don't have any more money in the bank because we have released all that money so as to buy these goods. So we have £60,000 worth of goods that we intend to sell. If we had bought, say, a car, let me just get rid of if we had bought a car, we would have said, oh, well, £60,000 has gone out of the bank, and then we have this new building. We would call this building. We would call this building an asset, right? But we're not buying a building. Because with a building, we're going to keep the building. But we are buying. We are buying expenses that we intend to sell. So let's just go back there again. So we are buying these expenses worth £60,000, and this is recognized with the letter E. Then let's now sell these else addresses. And when we sell these else addresses, imagine we sold these else addresses for £70,000 and we received the money in the bank. So you will now receive £70,000 in the bank, but we also recognize that you have sold these dresses with the letter I, called income. So we have, again, like I said, we always in accounting, we always recognize, in order to keep this equation balanced, the two events that have happened. You did buy some else addresses, so we recognize the fact that you have received some else addresses, but money also left the bank at the same time. You did sell. We recognize the fact that you sold it, and money has also come into the bank. And that, if you like, these are the two sides of the two events that have occurred. Now, let's look at our equation right now. We have 60,000 right now over here, plus 70,000 over here, because this 60,000 is cancelled out by this 60,000. And this is equal to 10,000 plus 50,000 plus 70,000. And this is 60 plus 70 is 130. 10 plus 50 is 60 plus 70 is 130. So our equation is still very much balanced. So This is what we refer to as revenue expenditure. Revenue expenditure are things we buy during the period or during the year that we intend to sell to make profit. And else addresses, if you like, are our revenue expenditure in this example. Revenue income is the receipt of funds from the things that we have just sold. And I guess that sort of makes sense because the definition of profit must be the difference between our revenue expenditure and our revenue income. So if I asked you just off the top of your head what profit was, you'd say to me, oh, 10,000. I mean, that's pretty obvious, right? It's 70 minus 60. Remember, this is how much is in the bank. So the way to find profit is to compare the 70 and the 60. So I could rearrange this equation so as to find my profit. And if I was to rearrange this equation up here, I would have assets being equal to capital plus liabilities plus income minus expenditure. And the income minus expenditure bit is what we call profit. And of course, you can see that we always add this profit back to, this profit always gets added back to capital. I mean, in this scenario, what do we have? We have 70,000 is equal to 10,000 plus 50,000 plus 10,000. Now, let me just explain what's really happening here in terms of the theory of this. Say, for example, that's the end of the business. We're done. This was one trade. Took the 60,000, bought all these else addresses, sold them. So if I say, you know what, I want to end this business tomorrow. I've got 70,000 in the bank. What's the first thing I'll do? I'll have to pay off all my loans. I pay off all the loans. That's 50,000 coming out of this 70,000. That means I have 20,000 left for, if you like, the owner, or the person who had invested that money. So he's ultimately started a business with 10, made an extra 10, and he walks away with 20. And this, if you like, is the fundamental idea of every single business. Every single business is built on this very fundamental accounting equation. So just to finish off, or just to reiterate, the key point here is that revenue expenditure in the accounting equation is recognized with the letter E, and these are all the things we had to, if you like, buy in the period to sell, to make profit. So for example, it didn't just have to be the else addresses. If you had paid rent, you can imagine how that would have looked. We would simply have the rental expense and you would have paid it out of the bank. So for example, we would have had E, we would have had A, you'd have rent here, for example, and you'd have, for example, I don't know, 2,000, and you'd have rent coming out of the bank, right? And that's simple. And that's pretty much it. You'd have rent, you'd have water, you'd have heat, you'd have light. All these things are used up in the period in order to arrive at that rental income that we receive for selling the finished product. So examples of rental expenditure: purchases. These are the actual else addresses. That's what we call them. So in accounting, when we refer to the word purchases, we're talking about the actual material that you have just bought. So for example, the else addresses: rent, light, water, heat, that sort of thing. And revenue income is what you have received from, after what you from selling the purchases plus everything you've had to do to it to make it sellable. Okay, great stuff. So, and we'll play around with this a bit more, and then we'll extend this in the next video. Great stuff. See you then.